It's time for Yahoo Finance's Market Minute. Stocks extending their tariff-fueled sell-off after China announced its retaliation with a 34% tariff on U.S. goods. Meantime, Intel shares sinking as the escalating trade war overshadows a reported deal with Taiwan Semiconductor. The stock got a boost after the information reporting an early agreement for TSMC to take a 20% stake in Intel's chip manufacturing operations, but you can see now moving to the downside. Meantime, Dell extending losses down over 7%. The personal computer company was the worst performer in the S&P 500 on Thursday. An analyst at Morgan Stanley calling tariffs, quote, calamitous for tech hardware companies. And Chinese tech stocks Alibaba, PDD, and JD.com sinking as the trade war escalates. These companies caught in the crosshairs as both countries struggle with slowing consumer demand and retaliatory tariffs. That's your Yahoo Finance Market Minute. For more, scan the QR code below to track the best and worst performing stocks.
Welcome to Wealth. I'm Julie Hyman in for Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks you need to grow your money. On today's show, market volatility spiking as the trade war escalates. We'll discuss how investors should be navigating that uncertainty. And it's the final day of Student Loan Week. Today we'll get tips for new grads adding repayments to their budget. Plus, we'll hear from Federal Reserve Chair Jay Powell live at 11:30 a.m. Investors hope to get insights into the FOMC's rate cut path, the impact of tariffs on the economy, and more. You don't want to miss that. Well, the U.S. labor market added more jobs than anticipated in March, suggesting steady momentum in the U.S. economy before the Trump administration's sweeping tariff announcement rattled global markets. With all that's happened in the past few weeks, what can we expect going forward for the U.S. economy? Corey Katenga, LinkedIn head of Economics Americas, is joining us now. Corey, we got a jobs report today that did seem to show that the economic backdrop, at least on the labor front, relatively solid. How should we read the numbers that we saw, and what should we be watching going forward?
So this month's jobs report covers mid-February to mid-March. So like you said, Julie, it's before we got this big announcement a few days ago. But what we do see in the jobs report is that the labor market still looks solid. We're continuing to add jobs, adding more jobs above consensus as we actually expected here at LinkedIn. Unemployment is low. Even the household survey, which usually looks fairly weak, looked pretty good this time. We see unemployment ticked up, but that's just because more people were coming into the labor force. Going forward, though, there are some key vulnerabilities. We haven't seen much growth in labor force participation. So as a result, we may not see as many new entrants and re-entrants into the labor market. So unemployment rises are likely to come from layoffs.
And so zeroing in on the government part of the employment report in particular, it looks like we're starting to see some decreases in government employment. I believe there was a 4,000 job decrease in last month's report. But when should we start to see some of the additional cuts play through there?
Well, based on this week's job openings and labor turnover survey, we should start to see the reduction in the federal workforce start to show up in the next few reports. So according to this week's jobs report, we had about a 5-fold increase in layoffs from the federal government. We saw that the federal government reduced from January to February by 10,000 workers, reduction from February to March about 4,000 workers. And we expect that to continue to go on as this works its way through the jobs reports.
And what about the tariff effect, right? Obviously, there's a lot we still don't know about how they're all going to be implemented, how long they're going to be in effect. But I am curious, within future jobs reports, where exactly we should be paying attention.
So there are some key sectors that are going to be more exposed to tariffs. We think about construction. We import a lot of wood in order to build our housing for residential construction. So that's going to be a key area to look at if it's the case that our wood, since a lot of it comes from Canada, is getting more expensive. Do we start to see any slowdown in construction and construction hiring? Right now, even on LinkedIn for March, we don't see that. We see that hiring is up about 13% compared to prior to the pandemic in construction. But I think that's going to be a key area. And then, of course, manufacturing. Those industries industries are going to be protected by tariffs, but then they're also going to be subject to retaliatory tariffs. So it's very unclear where that will net out, and we'll have to see what evolves with manufacturing, which has not been adding a lot of jobs the last few months.
Can you tell us anything about sort of the vibe read you're getting from folks who are posting on LinkedIn, right? Are we seeing the trepidation that we're seeing in the markets translate to what people are talking about?
We definitely see more folks posting about layoffs on LinkedIn in the last few months. That's increased about 35% since January, but it's also important to keep in mind that it's down 25% in March compared to March of last year. So some of that might just be a bit of a seasonal effect. So we're seeing much more chatter about layoffs. And we are seeing, when we ask our members how they feel about the labor market, they don't feel good. They don't feel good at all. Confidence is at an all-time low in terms of folks being able to progress in their career and keep and hold their job. So workers do not feel good about the labor market right now.
Thanks, Corey. Appreciate it.
Thank you.
Now time for some of today's trending tickers. Scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. And first up, we've got DuPont. It's falling today after China's top market regulator announced an investigation into DuPont China, that's a subsidiary, for suspected violations of China's anti-monopoly law. This comes as China launches a series of countermeasures against the U.S. following President Trump's tariffs that he would just announced. Other China-linked stocks are also taking a hit today. They include GE Healthcare and MP Materials. Now, GE Healthcare shares actually seeing a record drop. China is initiating an anti-dumping investigation into the imports of a type of medical X-ray tube from the U.S. That is a type of tube that GE Healthcare makes. And then you have MP Materials taking a hit. China retaliating against U.S. tariffs, U.S. export controls on rare earths. MP is a maker, or a miner, I should say, of rare earth minerals. And then we've got one bright spot here today. It's the best performer in the S&P 500. It's a company called Market Access Holdings here. It's the operator of a leading electronic trading platform for fixed income securities, and it announced record total portfolio trading for March and the first quarter. Those shares are up 3%. As we have been talking about, as money has come out of stocks, a lot has gone into fixed income as people are looking for areas they see as safer. That's been sending yields lower, sending prices higher, and obviously also just in general increasing some of the trading volume that we have seen in the fixed income market, which has apparently been a boon for a company like Market Access. Let's take a look at the broader market action now, 90 minutes into the trading day, because stocks are extending losses to end the week as the tariff-filled sell-off continues here, seeing stocks near the lows of the session for a second straight day after yesterday. The first blush reaction to the tariffs that were announced after the close of trading by President Trump on Wednesday, sending markets into a tailspin yesterday, and they closed at the lows of the session. On a day like today, it wouldn't be unusual to see a bounce. That is very much not what we are seeing. Joining me now, our own Josh Schaefer, who we've been talking in the newsroom. Obviously, on a day like this, we all talk a lot about what's going on, and that we have not seen action like this in quite some time, at least since 2020, right? And whereas then it was a global pandemic, now it is something that the administration of the United States has decided to do that is having this effect.
So I think that's sort of the looming question that investors have been wondering would be, well, if President Trump turned this on, would he turn it off? And sort of where is the level where that is? He came out this morning and said, my policies are my policies, not an exact quote, but essentially what he said, right? It does not seem like the Trump put, so to speak, where he would come in and turn these policies off because the stock market is crashing, is really in place at this point or in play. I want to pull up our tweet. I'm going to cite a tweet from our friend Sam Rowe over at Ticker because I thought he sort of got the mood in the room right pretty well when he put this out on X. He quoted it was a tweet from 2020 talking about the most compelling bull case at the time being that there was no credible bear case at the end of the pandemic, sort of as we were digesting that. Now he's saying maybe the most compelling bear case right now is that there's no credible bull case. And I think Sam is speaking to what we're hearing from a lot of Wall Street strategists right now and a lot of people we're speaking with, There's not a lot of people that are making a good argument for why stocks will go up right now. I don't think there's a lot of catalysts you can look at when we're just talking about a trade war. We're talking about the uncertainty. You haven't even had earnings season yet. We have no visibility into how that's going to work. And so I feel like as we continue to sit here and talk to people and say, okay, markets are significantly down. Where are you buying? Where are you interested? There's no one coming in and buying right now. There's no dip buyers, which is very different than a lot of the sell-offs we've seen throughout this bull market over the last few years.
I want to mention a couple new headlines from President Trump. He is saying he had a call with an official from Vietnam, and he says Vietnam wants to cut their tariffs down to 0. The market is not taking any relief, any solace in the fact that he's now starting to have some of these discussions. He also said, he talked about Fed Chair Jay Powell, who we're set to hear from in just about 15 minutes now. He'll be speaking to an organization that represents business and economics journalists. He says, it's a perfect time, President Trump saying, it's a perfect time for Jay Powell to cut interest rates. He says Powell is always late. It wouldn't be a perfect time for Jay Powell necessarily.
Is a random Friday a great time for the Federal Reserve to cut rates?
In Powell's view, at a time when it's not clear if tariff-induced inflation will be temporary or more, or less, or more permanent, less temporary. The Fed is in a really tough spot.
Yeah, I mean, you look at sort of how these tariffs are mechanically expected to work and impact the economy. It's supposed to boost inflation and take down growth, create that sort of stagflationary environment. Well, now you're putting pressure on both of the Fed's mandates. So what are you supposed to do if you're the Federal Reserve? I don't think there's a clear answer there, and they're trying to see how the actual data is going to come in. You were on earlier talking about the jobs report for March, right? That doesn't have any impact from any of these policies that we're discussing. We haven't had a look at really any data that's been impacted by the policies. So at some point, until we start to see how it's actually impacting it, it doesn't make sense for the Fed to do anything right now.
I mean, to be fair, we have had a number of investors on today. Brian Jacobson, for one, earlier in the day from Annex Wealth Management, saying, don't panic right now, right? Sure. Don't freak out and pull all your money out of the market, that eventually you will see a recovery in stocks. Of course, we don't know how eventually. And we've seen definitely a lot of investors looking to areas that they think are on a relative basis safe. Gold was catching a bit, although less so over the past couple of days. Treasuries continue to see a lot of inflows, as I was mentioning earlier. And we were yesterday seeing some rotation into more defensive stocks, consumer staples, or stocks that are viewed as more defensive. That's happening less today. We are seeing the selling today even more broad-based than it was yesterday.
Well, and some strategists have sort of pointed out, too, if you're an individual investor and now you're thinking, maybe my portfolio wasn't diversified enough, you might be a little bit too late to go into some of those staples names at this point, right? The sell-off has already happened. And so to some extent, you're sort of chasing a trade that has already sort of played out within the market. And then I think the other thing to bring up, Julie, too, you're talking about sort of the take a step back and relax aspect of this. I'll bring up cash, too. We just talked about the Fed. If you're sitting with money in a money market account right now, you're still getting an over 4% yield on that. It's a safe place to be. One of the most famous investors in the world has a large mass of money in Warren Buffett sitting in cash. That's not necessarily, you don't have to get into the market right now just because things are selling off and things look cheap. That is not necessarily how you have to trade or treat this sort of sell-off. And I think you're starting to see some of that action just broadly in the markets with people sort of just sitting, waiting, let's get a little bit more information before we make decisions, because as we're talking about it, clearly a very ongoing situation where there's a lot of nuance.
Speaking of ongoing situation, I mentioned a few moments ago those comments from President Trump that he had spoken to someone, a Vietnamese official, and that Vietnam wanted to take their tariffs down to 0. If you take a look at the Wi-Fi Interactive right now, I've got a chart of Nike. Now, Nike was one of the stocks that was the hardest hit yesterday because it has supply chains from China, supply chains from Vietnam. Many of the retailers, many of the footwear and apparel makers had actually moved some of their supply chains from China to other parts of Asia, particularly Southeast Asia, in the wake of the last round of tariffs. Nike among them, even though it still has some manufacturing facilities in China. Lululemon had moved. Anyway, So now getting this, even though we did not see an effect on the entire market, a big one from that headline in Vietnam, we're definitely seeing it when it comes to likes of Nike.
Yeah, no, and it makes sense, right? This is sort of the mechanics of exactly how these tariffs work and how you can think about how an analyst would price out the earnings expectations for a company like Nike, right? If they're going to get hit with these tariffs, that's going to impact their actual profits by a significant amount, where they're going to have to raise prices to a level that perhaps consumers wouldn't buy their goods, right? In general, it just would weigh on the overall business. So if those tariffs were to be wound back, that would be a positive sign for Nike. Nike, of course, a lot of other things going on with that company as well. Stock had been off, I think, about 30% over the last year, pretty much before this whole tariff scenario played out. So it's interesting to sort of think about, you see this broad sell-off, you see a lot of these stocks moving significantly lower, but each company, remember, still has kind of their own story playing out. And I think Nike's ability to still create products that sell and sort of expand beyond the Air Jordans and the Nike Dunks of the world that aren't selling anymore for shoes is still a big part of that story as well. Yeah,
great point. Thanks. Appreciate it, Josh. Well, before we head to break, we want to talk about treasuries quickly here as well as we look at all of the big market moves. Treasuries definitely part of that big market moves. We are seeing yields plunge across the board. That's because people are buying treasuries. They're going in. The prices move inversely to yield, so prices up. Yields are falling here on these concerns about growth in the U.S. Coming up, we've got an expert separating the fact from fiction when it comes to filing your taxes. That's next on Wealth. Breaking news now. Klarna reportedly pausing its IPO amid the market upheaval. That's according to Dow Jones. This was expected to be one of the year's biggest financial company listings. Klarna was seeking to raise at least $1 billion in the IPO, targeting a valuation of more than $15 billion in that listing, according to Bloomberg. The Swedish-based buy now, pay later company had filed publicly for a U.S. IPO last month, saying it has applied to list on the NYSE under the symbol KLAR. That listing being pulled comes as Wall Street weighs the potential impact of market swings on a group of large companies seeking to list in the U.S., including AI cloud computing provider CoreWeave, which has seen a volatile start to its public debut. And by the way, you can track more of the private market data on our Yahoo Finance platform that shows Klarna's valuation, funds raised, and more. April 15th, it's under 2 weeks away when taxpayers will have to file their taxes for 2024. But looking ahead to future years, Senate Republicans have issued their tax plan with many potential changes, like not taxing tips or even eliminating income tax. Joining me now, Mark Kohler, KKOS Lawyers founding and senior partner. So I know you want to quiz me, but we always talk about these plans. We don't know how much of this is going to get through.
Yeah.
But what should people be watching in terms of what it's going to change for them?
Well, you bet. I actually read the 70-page blueprint last night. It was a nice little bedtime story.
I'm sure.
No, but a couple of things people need to know. There is nothing in it that says we're going to eliminate income tax.
Right.
It's about trying to find the savings to provide tax cuts to help give average Americans, middle-income Americans, some more breathing room financially. And it means we either got to make more money or we've got to cut money somewhere to do that and make a balance in 10 years. So this was the Republicans' first shot at it. It kind of goes back and forth. It's like watching sausage made. You do not want to see this.
No.
It's a little ugly, but it's getting clearer and clearer. Now it's on the House Republican side to take their shot at it.
And you wanted to quiz me about common tax mix.
Well, you know,
I'm sure I have a lot.
It's been a stressful day for a couple of people. I was on the floor of the stock exchange yesterday. No one was jumping out of windows. It's short-term pain, long-term gain. Let's try to stay strong.
See.
But one thing I do want to add to people is to not stress further. Tax season is upon us. The tax extension deadline is April 15th. Let's change our perspective. Everybody, we don't need to freak out this weekend. So I'm going to ask you, I've got a few questions real quick.
Yeah, let me know.
So do you think it's better to file by April 15th or file an extension? What would you say?
I don't know, but I have filed for extensions before, I will say.
Did the sky fall? You were okay?
It was okay.
Yeah, you're right. Do you know you actually you actually decrease your chances of an audit when you file an extension? And it gives you more time to file, to prepare. Maybe you're going to interview a new tax advisor. So that's the time to do it. So people don't need to rush. Now, it's not an extension to pay. So if you think you owe, send in some money. And if you're certainly due a refund, go ahead and file. But don't listen to anyone that says, you got to hurry and file.
Got it.
File an extension.
File an extension. Okay. Yes?
Oh, no, go ahead.
Quiz question.
Okay, I'll ask you now. So
This one I know the answer to.
Oh, you do? Okay. Well, over 50 million Americans now have a side hustle. And the question is that going to be tax greater or not? It's having a side hustle going to increase your tax rate.
Right. Is gig income taxed at a higher rate?
But what do you think? True or false?
I think false.
Yeah, you're absolutely right. And the reason why is because if you have a side gig, you now get additional write-offs. Home office, auto, dining, computers, electronics. So with that side gig, again, it's a common strategy. Take more time, dig up all those write-offs, and you're going to actually pay less tax on that gig income because you don't get those write-offs with your day job.
This is one of my favorite ones. Is it good to get a refund?
Oh, yes. We can jump over that.
Yeah.
I don't know. What do you think? Do you want a refund?
I think you don't want a refund.
Yeah, you are so smart. I've got to tell you, you're doing great. Well, when you get a refund, you really just realize you gave the IRS an interest-free loan.
Right.
So ideally, we want to end up at zero. We don't want to owe. We don't want to pay. We want to shoot for that the best we can. Now, if you're going to need a big refund, don't go buy a big screen TV, people, of course. But let's maybe adjust our withholdings or deposits so that we get closer to that zero. So.
We got to leave it there, Mark. I'm sorry.
That's okay.
It's a busy day. Mark Kohler, thank you so much for coming in. Coming up as we await comments from Fed Chair Jay Powell, let's take a look at the markets here. We are seeing still stocks a little bit above the lows of the day, but still deep declines, especially on the 2-day basis, with the Dow falling over 1,000 points. We'll be right back. Stocks extending declines following Thursday's massive sell-off. We're seeing all three major averages deeply in the red here. Federal Reserve Chair Jay Powell is speaking in moments at the Society for Advancing Business Editing and Writing in Arlington, Virginia. Yahoo Finance Fed reporter Jennifer Schonberger joining us now with the latest. What are we expecting to hear from him?
Good morning, Julie. Fed Chair Jay Powell says that bigger than expected tariffs could lead to longer lasting inflation. A change in an initial view put forth a couple weeks ago where inflation from tariffs could prove temporary, while also noting that the Fed is unclear what they're going to do with interest rates at the moment. In a speech in Northern Virginia, Powell says, quote, "It's now becoming clear that the tariff increases will be significantly larger than expected. The same is likely to be true of economic effects, which will include higher inflation and slower growth." He says that the outlook is highly uncertain right now and that there are elevated risks to the downside for inflation and employment, though at the moment the economy looks to be in solid shape. He says higher tariffs are likely to raise inflation in the coming quarters. Powell says that avoiding longer-lasting inflation will depend on keeping longer-term inflation expectations in check, the size of the effects from tariffs, and how long it takes for tariffs to work their way through to prices. Now, the Fed chair stressed that it is the central bank's job to ensure that a one-time increase in prices does not lead to ongoing inflation. He says the central bank is properly positioned now to await clarity before making any adjustments to interest rates, saying that, quote, "It's too soon to say what the appropriate path for policy will be." So, Julie, very much a wait and see right now, but committed to keeping inflation in check. Back to you.
And of course, President Trump weighing in on all of this today, saying it's the perfect time for Powell to cut rates. Of course, Powell has remained steadfastly apolitical, right, in his various press conferences. But as you and I have talked about and you've written about, the Fed's in a tight spot right now in terms of where these tariffs position inflation versus growth.
Yeah, I mean, Julie, look, it's kind of like the president's trying to force the Fed's hand, but I think you could also say that the bond market is doing the Fed's job for it, because you look at the yield on the 10-year Treasury today, and it's below 4%. So while the Fed adjusts rates at the very short end of the curve that dominoes through to other interest rates in our economy, it's ultimately the yield on the 10-year Treasury that's really setting a lot of these longer-term borrowing costs, and that can be buffeted by much more than just Fed policy that's being set.
And what we've heard from Powell in recent public commentary What have we learned about what the Fed's going to be looking at to see if indeed the tariff-induced price increases are more permanent or transitory?
I think that inflation expectations, the softer data, are going to be key. The short term, they're not so worried about. It's the longer term expectations. Right now, you look at the tips market versus the nominal. Those seem to be in check for right now. We did see longer term inflation expectations pop up in the University of Michigan survey that we haven't seen that in other surveys. Of course, they'll be watching the outright data as well. And as you know, a reading recently for February on their preferred inflation gauge, excluding those volatile food and energy prices, had already jumped up to 2.8%. And that was before we really saw these aggressive tariffs announced. So as these begin to go into effect, if they remain in effect, and as businesses anticipate the potential impact of that, we will see how that works through the actual hard data. Remember, the Fed is very much an animal that likes to look at the hard data. And right now, Powell says they're trying to sort of make sense between what the hard data is saying and what the soft data is saying.
Right. Well, Jay Powell is speaking now, so let's listen in.
A combination of low layoffs, moderating job growth, and slowing labor force growth has kept the unemployment rate broadly stable. Turning to the other leg of our dual mandate, inflation has declined sharply from its pandemic highs of mid-2022. It has done so without the kind of painful rise in unemployment that has often accompanied periods of tight monetary policy that are needed to reduce inflation. More recently, progress toward our 2% inflation objective has slowed. Total PCE prices rose 2.5% over the 12 months ending in February. Core PCE prices, which exclude the volatile food and energy categories, rose 2.8%. Looking ahead, higher tariffs will be working their way through our economy and are likely to raise inflation in coming quarters. Reflecting this, both survey and market-based measures of near-term inflation expectations have moved up. By most measures, longer-term inflation expectations, those beyond just the next few years, remain well anchored and consistent with our 2% inflation goal. We remain committed to returning inflation sustainably to our 2% objective. Turning to monetary policy, we face a highly uncertain outlook with elevated risks of both higher unemployment and higher inflation. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. Our monetary policy stance is well positioned to deal with the risks and uncertainties we face as we gain a better understanding of the policy changes and their likely effects on the economy. It is not our role to comment on those policies. Rather, we make an assessment of their likely effects, observe the behavior of the economy, and set monetary policy in a way that best achieves our dual mandate goals. We have stressed that it will be very difficult to assess the likely economic effects of higher tariffs until there is greater certainty about the details, such as what will be tariffed, at what level, and for what duration, and the extent of any retaliation from our trading partners. While uncertainty remains elevated, it is now becoming clear that tariff increases will be significantly larger than expected. And the same is likely to be true of the economic effects, which will include higher inflation and slower growth. The size and duration of these effects remains uncertain. While tariffs are highly likely to generate at least a temporary rise in inflation, it's also possible that the effects could be more persistent. Avoiding that outcome would depend on keeping longer-term inflation expectations well anchored, on the size of the effects, and on how long it takes for them to pass through fully to prices. Our obligation is to keep longer-term inflation expectations well anchored and to make certain that a one-time increase in the price level does not become an ongoing inflation problem. We'll continue to carefully monitor the incoming data, the evolving outlook, and the balance of risks. We're well positioned to wait for greater clarity before considering any adjustments to our policy stance. It is too soon to say what will be the appropriate path for monetary policy. We understand the benefits of a solid economy where workers can find jobs and inflation is low and predictable. We also understand that elevated levels of unemployment or inflation can be damaging and painful for communities, families, and businesses. That is why we at the Fed will continue to do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Most importantly, thank you for being here. This feels like quite a moment to be speaking with you, and I want to thank you for your time. He's got it. I want to thank you for being here, and thank you for taking the time to speak with this group of business journalists. Also like to give a special thanks to Heather Long with the Washington Post, who helped make this event possible. So for starters, sir, how's your week been?
Just fine, thank you.
Care to elaborate?
So far, so good.
Chair Powell, yes, thank you so much for being here and taking our questions. You were talking about the economy as being a very strong economy. You characterized inflation as coming down, employment as being very strong still. However, President Trump earlier this week, when asked about the market volatility we've been seeing, said the volatility was, quote, to be expected. This is a patient that was very sick. We inherited a terrible economy. A lot of voters did and do agree with that assessment, or at least in part. I'm wondering how you would respond to that assessment and the disconnect between the story of the data and the way a lot of people are feeling about the economy.
Sure. So let me just be clear at the start. I make it a practice not to respond to any elected officials' comments. So I don't want to be seen to be doing that. It's just not appropriate for me. But the situation, I think, is this, and people, when they're surveyed, they are unhappy about the economy. That seems to largely reflect the increase in the price level that happened when inflation was high, 2021, 22, and 23, largely. Inflation is now back down to much more normal levels. Unemployment is low. The economy has been growing, but people are still experiencing that high price level. In other words, prices don't go down. They know they're paying much more for the basic necessities of life. And they're right that they are, and they're not happy about it, and they're right not to be happy about it. So I think that accounts for the negative sentiment. Of course, we're looking at inflation, which is the change in prices, and we're seeing that has come down quite a bit, and that, unemployment is actually low. It's sort of very close to measures of maximum employment, and the economy's growing. So all those statistics are good, but the price increases of the past few years are weighing on people's budgets.
So I'm from Milwaukee, and I've been talking to business leaders, executives, and consumers in our community, in our region, for the last few weeks, mostly before this week's news. Chairman, they're troubled and they're nervous. One business owner told me, if there's a hint of a recession, we're cooked. And he asked me to share that with you. What's your response?
So I guess I would say, let's start with the fact that the incoming data right through this morning's employment report, which admittedly is from roughly a month ago, the week of March 12, they took the data in, it still shows us a solid economy. Unemployment's still low. I understand the uncertainty that's weighing on people. You ask about a recession. We don't make a probability forecast of how likely it is for there to be a recession, but many outside forecasters do, and many of them have raised the likelihood, albeit from very low levels. It's not something that anybody now is forecasting, or some people are starting to. And so there's not much more I can say about that. I realize that the uncertainty is high, and what we've learned is that the tariffs are higher than anticipated, higher than almost all forecasters predicted. We still don't know where that comes to rest, though, and we're just going to have to see that through.
At a congressional hearing last year, one of the U.S. representatives said that you were pretty boring, and you thanked him and said that you considered that a very high compliment. And in fact, I feel like it's one of the roles of the Federal Reserve, especially since the housing crisis, to be kind of a ballast, especially in the face of the volatility of the markets and the dramatics that we can experience with the economy. Very steady, no surprises, very reliable. In a moment like this, which also has a lot of drama and unpredictability, but it is not necessarily from an economic crisis. It's by design, it's political. How do you see your role in this moment?
So I think all of the values that you touched on are, in fact, the values that we try to live by. You know, we're driven by, you know, analysis and careful thought and discussion and debate and the merits of things. We try to stay as far as we can from the political process. We don't look at political cycles or things like that. So, and I think people expect that from us. They expect us to tell the truth, and that's what we're going to do. But at the same time, we don't want to be part of the broader political discussion about the wisdom of policies that are not assigned to us. We're not responsible for trade policy, immigration policy, fiscal policy. So we don't comment on those. Decisions are made by others, and what we do is we use our tools to try to achieve the goals that Congress assigned us, which is maximum employment and price stability. So I like to think that over time we're a source of calm, rational analysis and also of stability. That's really what the business that we're in is, providing financial and macroeconomic stability to the public. That's really our purpose.
So how can businesses and individuals and the Fed make plans for the future when so much is being dictated by the actions of a single person? And do you see yourself as the consoler-in-chief on economic matters?
No, I think, take a step back. What's happening is, as I mentioned, the new administration is making, you know, significant policy changes in trade, immigration, fiscal policy, and regulation. And you're still just a couple of months into the administration, and that process will take place. And at a certain point, the new policies will be on the table. They will be having the effects they're going to have on the economy, and uncertainty will decline. Right now, there's a lot of uncertainty about where all that's going to sort out, the forms it will take, and what the economic effects will be. If you fast forward a year from now, the uncertainty should be much lower. The actual effects of the policies should then be pretty manifest and clear. So I think I understand why it just is highly uncertain, both what the policies will turn out to be, exactly what they'll turn out to be, and also what their effects will be in the near term. We just have to go through that process, and it is just kind of a manifestation of our election cycle and a new administration coming in with new policies.
I mean, given all of the change happening and the fact that we are in a period where things have not settled in yet, and that the Federal Reserve and you as chair are very projection, data-driven, policy-driven, how do you handle a moment like now? I mean, can you tweak your plans and projections? Do you have to reset them?
So, what we've had since in the last few months is, from the staff, has been a placeholder. Rather, they wouldn't call it a forecast because it's so uncertain. They call it a placeholder. And that's kind of how we've been thinking about it. So it's a good time to take a step back and let things clarify. That's why it's just too soon to say what the appropriate monetary policy response will be to these new policies. It is just too soon to say. We can't say with any confidence today. So that's what we're doing. We've taken a step back, and we're watching to see what the policies turn out to be and the ways in which they will affect the economy, and then we'll be able to act. Fortunately, our policy stance is in a good place for us to do that. We're probably moderately restrictive, let's say. So it's not really tight policy, but it's which is appropriate since inflation is a bit above target. So we think we're well positioned to address whatever may come. And in the meantime, I'd say we're waiting for greater clarity before we consider adjustments.
Business owners in Wisconsin have told me that they can't make their plans. They want to expand. They want to build a new facility. They want to hire or do whatever the future calls for. They say, we're trying to look around the corner. We're not even sure where the corner is, and we're not even sure what's around the corner. Sounds like they're in the same position as you are a little bit.
No, we hear the same thing. Of course, we have an incredible network of contacts with businesses and also universities, nonprofits, all different sectors, through the reserve banks and also through the Board of Governors. And that's what we hear. But again, it's a process. We're going through it, and I think we will know when we know what the policies are exactly and what their implications will be for the economy. That will all become clear, and I think that'll be a time when people can make decisions. In the meantime, though, I get it. We're hearing that a lot from people, and we are kind of in the same place, which is waiting for clarity about what our policy path should be.
It might be months away.
We'll have to see.
Yeah.
As you're talking about placeholders right now and having something in the place when there's so much that we don't know, it does occur to me that this is not the first economic shock that you have steered the markets and the economy through. Obviously, there was COVID almost exactly 5 years ago. It seems similar in certain ways with a lot of uncertainty, a lot of shock, also potential disruptions to prices and to supply, which is very much in the Federal Reserve's wheelhouse. I mean, from where you sit, can Liberation Day be compared to kind of the economic effects of COVID? Are they totally different, somewhat related?
I think each situation is different. There was COVID. There was also then, in the response to COVID, then there was high inflation, and then there was soft landing, and then and now we have new administration and changes in policies. And every situation, it kind of rhymes, but it's not exactly the same thing. And so in this situation, what we face is what I mentioned in my remarks is you actually have risks for higher unemployment and higher inflation, and that's difficult for a central bank because our tools, which consist of interest rates, either slow down or speed up the economy over time. And higher unemployment would call for speeding up the economy, and higher inflation would call for slowing it down. So you can be in a situation, if we find ourselves in that situation, we look at how far each of the two variables is from its goal, and we ask ourselves, how long would it take to get back? And we weigh those things and make a decision about what to do. But there's no question that's a different situation, very difficult situation. When we faced high inflation, it was painful for the country, painful for the people that we serve, but we knew what policy needed to be. We knew we needed to raise rates quite a bit. During the pandemic, we knew what we needed to do. It was very clear the direction that we needed to take with force, and we did.
It's almost a situation potentially where the dual mandate is at odds with itself.
The two goals are, as we say, in tension, or they may be. I'd say that's not what we're seeing right now, but it's the effects at the margin right now would be for higher inflation and perhaps higher unemployment, but that's a marginal effect. I would say you're not in a situation like we were in the 1970s where the two goals were really both pulling in opposite directions and required. It's just very hard for a central bank to be the answer to a situation like that. But that's not the situation we're really in today.
One of the questions from the audience that we had is, if unemployment takes off and inflation takes off, which lever do you go for? Which lever do you, what do you do?
So we actually have we have a document called our consensus statement, or the longer version is Statement on Longer Run Goals and Monetary Policy Strategy. And the 6th paragraph of that actually contemplates when the two goals are in tension. And what it says is, think about how far each variable is from its goal, and think about how long it would take for each to get back. So in a way, it's an equation. You're comparing two quantities which each have two variables. And then you say, you look at that and you think, what do we need to do? And typically this doesn't happen very often, but if one of them is further away, then you would focus on that one. In the case of high inflation, they actually both pointed in the same direction. The labor market was overheated and inflation was very high. So both of those called for tight monetary policy. This could be different, but again, we're not actually facing that today.
I feel like there's another tension inherent in your job, which is that you're looking at the macro economy, at the global economy really, and the US places in it, but also the data you're looking at is very profoundly human, as Jim has been pointing out. Jobs, I think, and prices are probably the two most human pieces of data, and certainly in our day-to-day experience, probably the things that loom the largest. How do you reconcile those two things when you're looking at the data, like both the global markets and knowing that the data represents a lot of lives and jobs and egg prices and things like that?
So I think at the Fed, we always keep a focus on the people that we serve, and we know We know and are very conscious daily that the things that we do have a real effect on people's lives. We know that, and it really does focus the mind. And I think if you talk to people at the Fed, there's a very strong commitment to serving the public as well as we possibly can. Economic events are just very, very unpredictable at times, and there are shocks that you can't see coming. But nonetheless, our job is to, whatever happens, use our tools to bring the economy back to stability, back to price stability, back to maximum employment. And that's what we do. But you're right. We try to keep everybody in the room with us when we're thinking about what to do.
So, in response to the last round of tariffs, Harley-Davidson, which is based in Milwaukee, moved some production to Thailand. Now the company might be whipsawed again by the new tariffs. It could be really devastating for sales, for employment, for the future of that company. But a lot of companies are in that same position. And what do you say to companies like Harley-Davidson and their workers?
So it just isn't, I really want to stick to our knitting. I mean, we have this great thing called our independence of monetary policy, and that's critical for us to be able to do our job. But for us to keep that independence, we need to not succumb to the temptation to want to be a player on issues that are not assigned to us. And trade policy is one of those. There are many, many issues that people love to try to pull us in on, almost every issue, really. And we just need to stick to our knitting, not get pulled into those things. And so trade policy is a classic one. Energy policy is another. Climate change, immigration is not really, although all of those things have economic implications, and it gets argued that way. But if we treated those as our job, the case for our independence would disappear. So I really can't comment on, we hear the same stories like that, but honestly, the policymakers who are charged with that, they're probably hearing the same stories too, and they're reaching a judgment about what's in the best interest of the country in the long run. That's what they are doing, I guess, and that's, so it's not for us to comment on that.
What happens inside the Fed at a moment like right now, when there's so much change and quite a bit of uncertainty? When you're watching things unfold, what does that look like, practically speaking? What are people doing inside the building?
So I'm very proud to work with the people I work with. I can tell you that in times like this, or times like the pandemic, where the global financial markets were shutting down, the global economy was shutting down, people step forward and they say, "We've got this." These are career people who were here for the global financial crisis. They've got 25 years, 35 years of experience with crises, and they step forward and it's just incredible what they can do and how good they are. It's a great honor to work with them. So right now isn't that situation. We have the situation we have. So our trade people and our inflation people and our macroeconomists are all working hard to kind of digest the news of this week and try to filter that into the forecast that they'll make. And policymakers are doing very much the same thing. And we're reading everything we can about what's happening and lots of outside analysis too. We don't have an FOMC meeting until May 6 and 7. So that's really a process that lasts several weeks, and we're not quite at that stage yet. But we're kind of thinking ahead to that and working through all of that. I will say though, it feels like we don't need to be in a hurry. It feels like we have time to. Yes, it feels like we don't. No, it's like I said, you have inflation is going to be moving up and growth is going to be slowing, but it isn't really. To me, it's not clear at this time what the appropriate path for monetary policy will be, and we're going to need to wait and see how this plays out before we can start to make those adjustments.
Question from the audience. One of our SEBU members is: are you in contact with other central bankers in other countries at a time like this? Yes, pretty frequently.
Absolutely. And the same was true during the other crises I've been through. Not only that, though, we do meet very regularly. The IMF World Bank meetings here in Washington twice a year. We go to Basel multiple times a year to meet. That's all central bankers. And there are also G20 meetings, G7 meetings where the central bankers are there. So we're kind of regularly meeting and talking. And when we're not doing that, we're also texting each other. And
is there a group chat?
I'm not at liberty to say. No. No, there's not.
And have you talked to those central bankers this week?
Recently, yeah, I didn't want to get too specific about this, but yes, I have.
What's their sentiment? Can you characterize that?
I'd rather, again, I don't comment on what my international colleagues say, or it's not appropriate. But we're talking about events. We're talking about the implications for the economy. We're discussing what we're hearing from markets and from business people and for from the elected governments too. It's all the things you would expect us to be talking about on a regular basis. It's one of the best things about this role is that the central banks have a lot. We're all non-political, so we think about things in quite similar ways, and they're real bonds. We're not lobbying each other ever on policy. It's just never. That's just not a thing, because we do our policy here, they do their policy there, but we develop really, really good relationships and bonds with them, and it's one of the real pleasures and benefits being able to talk about this, just not only with the great people at the Fed, but also with the leaders around the world.
I mean, it's interesting because it is a job of enormous responsibility and power, but it's also a job. How would you characterize the job of Fed chair? Like, how is it as a job?
Honestly, that's what it is. I really feel just like another person doing that job.
Really?
Yeah.
You just like...
That's how it is. I'm doing a job. I have a job to do. I actually really like the job. I like it a lot. I enjoy it. It can be stressful at times. Nonetheless, incredibly interesting, great people to work with, really important. What more could you want? But that's what it is. And I'm blessed by working with great colleagues who are really committed to getting it right. I mean, fully appreciate how important it is that we get it right, and do everything we possibly can to bring the best thinking, the best analysis, and debate things, over and over until we feel like we're in the right place. At the same time, there is no certainty in this. You can be wrong because the economy can zig when you thought it was going to zag.
So your term as Fed chair ends about a year from now. What do you think about your job security?
I fully intend to serve all of my term.
Excellent. I mean, as we're getting close to wrapping up, I did want to ask something a little bit out of the box. I think because you do have a position of such great responsibility, people are very curious about you, and I think people tend to read into everything a Fed chair does, small gestures, word choice. I know it's part of our jobs in this room to pore over every word you choose. I did want to ask about one thing that I've wondered about for years, which is your tie. You always seem to wear a purple tie, and every time I think I've seen you, you've worn a purple tie, and I'm wondering if there's significance to that?
Well, at the beginning, the only significance was that I like purple ties.
Okay.
But I will say, so then the next press conference, I reach for a blue tie or a red tie, and I go, maybe not, And so I wind up wearing purple ties. And then it becomes a thing, and now I definitely wear purple ties all the time.
Okay.
But I felt like, it just felt a little awkward to be wearing one that was identified. We are strictly non-political. I can't stress that enough. We are not, it's not that we're bipartisan. We are non-political. We don't do that. And so purple is a good color for that. That's all. Plus, I like purple ties.
Sorry, I didn't give you a purple guitar pick. I have one other Milwaukee question that I overlooked here, but in Milwaukee and other parts of the country, the housing market is out of whack. In our market alone, in southeastern Wisconsin, there's 5,000, the market's out of whack by like 5,000 houses that need to be on the market for it to have equilibrium. And a report this week said tariffs could tack on some $6,000 to the cost of building a new home. How long are people going to sit on their cheap mortgages from COVID? Thank you very much. And before they move on, before the market frees up.
So you have several things there. The first is we just haven't built enough housing, and we haven't kept up with the demand for housing. So there's an underlying shortage. Before the pandemic, there was a real housing shortage. And by the way, that's happening in many comparable democracies around the world. The second thing is, lock-in, as you say. There were very, very low mortgage rates during COVID, and people are kind of locked in. It would be very expensive to move, and that'll of course wear off over time. And you also mentioned, the costs of materials that might be imported, lumber and nails and things like that. And yeah, and also labor, a lot of labor from in the home building business has been traditionally immigrant labor. So yeah, the sort of new build market, it may face some cost pressures as well. That may very well be the case. That's what we're hearing from home builders, for example, both on the labor side and on the materials side. But even once these short-term things happen, we're still going to have not enough houses. And so it's all, I think for a long time, we're still going to see upward pressure on housing prices, maybe until population growth slows or until we catch up.
You mentioned that we're kind of in a period of waiting right now to see how policy ripples out through the economy. How long do you expect that to take? How long do you expect these big policy changes to show up in our day-to-day lives, in prices and supplies and things like that?
I mean, for a while, we didn't know what was coming on April 2. Now we know what came on April 2. We don't know. There's a lot more to be said about how all that shakes out. But we've come through that, and I think you now know that the tariffs are larger than people were generally expecting. That much now at this point. And you'll know more as you start to see the effects on the economy. So, as the months go by, it's hard to say exactly when you'll know. But clearly that learning process is ongoing. We're just seeing that these are new policies, not just the tariff policies, but the other ones as well. There'll be important fiscal legislation coming up fairly soon, and there'll be regulatory changes, significant regulatory changes. You have to really look at all of that to see what the overall effect will be. So I can't give you a date, but all of that is now kind of coming into place at sort of the speed you would expect policy changes to be, and then we'll begin to see the real economic effects as the year goes on. But again, I can't give you a really specific date. Is
the fiscal legislation the tax cuts?
Well, yes. I mean, I know they're contemplating, and we don't comment on fiscal policy, but what I read is that they're contemplating, making the Tax Cuts and Jobs Act cuts permanent, and also perhaps some other things as well. We wouldn't be. We have a sort of a placeholder for that too, but that's really not ours to comment on. But that's what I was talking about. Yes.
So I have a question from a friend in Milwaukee who said she has clients that have deals ready to go, businesses that are ready to launch from their garage to a private equity deal, and they're just stuck in their garage right now. How long do you think, what do you think the impact of the uncertainty these days will have on the private equity deals?
So again, we're hearing a lot of that. People are just kind of waiting waiting for clarity. So, and I can't tell you when that will pass, but ultimately it will pass. We know that at a certain point we'll know enough to know what the uncertainty will decline, and we'll be able to see with real clarity what the policies are and what their effects are. So, you're right. We hear the same thing from businesses and just from people that they're kind of waiting and seeing. There's a lot of waiting and seeing going on, including by us, and that just seems like the right thing to do at a time of elevated uncertainty.
What economic indicators are you watching right now? I mean, very famously, you look at the CPE and obviously the CPI and things like that, but are there any economic indicators in this moment, in these circumstances, that you are watching, focused on,
Sure.
interested in?
So the basic two big data pools are the data around prices and around employment. And we get, in the employment area, we get just really, that's an area where we actually get pretty good data. Although the survey response rates have been lower, nonetheless, we get a lot of different data. And it's not just unemployment, it's participation, it's by age group and things like that. It's wages, it's many, many different things. It's jobs, it's quits, all the job creation, quits, openings, all those things. So that's one thing. On inflation, we target PCE, personal consumption expenditure inflation, not CPI, and the two are broadly, they move they move together, but 25 years ago, the Fed switched to PCE. The public looks at CPI. It's kind of a little bit of a thing, but because we think, it's really just a better way to capture the inflation, the cost pressures that households and businesses feel. We think it's a better measure. And that's what we look at, but they're not that different. I mean, they look at different measures. Ultimately, they're pretty close together. Those things, on growth, you look at what's happening with consumer spending. The economy is overwhelmingly driven by consumer spending. So you look at how are consumer surveys, how are they feeling, how are they spending? Sometimes the surveys are very negative, but they keep spending. That's been happening really for a while. People spent right through the pandemic, and they spent right through this time of higher inflation. They kept spending, and forecasters kept thinking, like us, kept thinking that consumption would slow down. But that's a really critical thing. After that, business investment is a big chunk, and you look at that, and that is also susceptible to sentiment. Businesses, if they don't know what to do, they're not going to do an acquisition, or they're going to hold off on building a factory or a plant or hiring people and things like that. So we look at, I could go on for a long time. We look at a lot of data, and we try to make sense. We also talk to people who are in the real economy. I grew, my career was mostly in the private sector, talking to people who ran businesses. And for me, the story doesn't come together until I actually hear from people who are in the economy doing things and what they're feeling and seeing, and then it sort of fits together better.
Is this like via the Beige Book, or just
Beige Book? Thank you for mentioning the Beige Book, and I hope you read it.
I love the Beige Book.
See, that's great. Everyone should read the Beige Book. The Beige Book comes out sort of mid-FOMC cycle, and it's all the 12 reserve banks and all of their incredible context, what they're saying about what's going on in the economy. So if you want to know, you can look at the national data, but if you want to know what's going on in regions and at different industries, you look at the Beige Book. So it's really a critical thing. And actually, the reserve bank system that we have is an enormous strength of the Federal Reserve System. We have these 12 reserve banks with their own, economics departments and own participants on the FOMC. So that's a great thing to look at.
I'd like to ask you about another body of work that many of us know that you're familiar with, and that's the Grateful Dead. So, question for you, sir. American Beauty or Terrapin Station?
American Beauty.
Well, it's not even a
Not even close.
That was
Ask me a
so
hard one.
fast.
That's my era.
Working Man's Dead?
Yes.
Or Europe 72?
Oh, both. Yeah,
come
that's
on.
my era. We're in the same era here. So that's, for me, it's late 60s to mid 70s. So
Touch of Grey, what do you think?
It was their only hit, but it's a good song.
Okay.
Yeah.
Finally,
We're going to do this?
I feel like you're speaking another language.
there's a well-known Grateful Dead bootlegger who, with I believe the permission of the band, Dick's Picks, who's put out. So what's your recommendation of those hundreds of
I
Dick's Picks?
don't have any Dick's Picks. Like I said,
Come on.
my real interest was late 60s to mid 70s.
Yeah.
And I saw them a bunch of times, and I know every note on every song from that era, but since then I've been busy, actually.
Well, we thank you for taking time out of your schedule to join us here, and we appreciate your work.
Thank you very much. Thanks, everybody. Thanks, Jim.
That was Federal Reserve Chair Jay Powell discussing the effect of tariffs on the U.S. economy. My favorite part was at the end when he was asked about his fandom that had been reported upon for the Grateful Dead. But hey, everybody has their own part that they like, I suppose. I want to bring in our own Jennifer Schonberger as well as Miles Udlin, who's with me on set. Jen, let's start with you. I imagine that your takeaways were probably more substantive from the Q&A than his affinity for purple ties and which Grateful Dead albums are his favorite.
Tie there.
Sure.
Yeah, I did like the purple tie, but yeah, it's very clear to me that Fed Chair Jay Powell and the rest of the Fed remain in this wait and see mode. They want to see how the effects of these now bigger than expected tariffs shake out. And what really struck me was how the Fed chair tried to project calmness, sort of downplaying this a bit, saying, in a year from now, this uncertainty will have lifted and we will know where things stand. This is really, he chalked it up to the new administration coming in and making changes in policy. I also want to point out that the Fed chair seemed to sort of inadvertently answer the president's social media post, which he put out right before Powell spoke, where he said, "Cut interest rates, Jerome, and stop playing politics." But Powell says he doesn't feel like they need to be in a hurry right now. They have time. They want to gain greater clarity. And the last thing that stuck out to me is that for those who have said that the president has put the Fed in a bit of a difficult position between a rock and a hard place when it comes to balancing their dual mandate of inflation versus employment, he says those two are not really in tension right now. This is not a 1970s situation where you really had very high inflation and low growth.
Thank you very much. Miles, there was definitely a little bit of a cognitive dissonance there between Powell, who was characteristically very even-keeled, very calm, and then the red that we're seeing on our screens.
Yeah.
And he didn't give any solace to people in the market who might have wanted him, although there was not really a chance he would come in and say he was somehow going to ride to the rescue.
Yeah, I mean, I had three main takeaways. I think the obvious one, which the market immediately hated, Powell's prepared remarks, where he has, towards the bottom of the speech, the line, our obligation is to keep longer-term inflation expectations well anchored and to make certain that a one-time increase in the price level does not become an ongoing inflation problem, AKA, we're going to wait. Right, and also that this is not an emergency press conference setting. I'm not going to come out here and say anything that you didn't, you were hoping for me to hear, et cetera, et cetera. And of course, the market went to lows of days on those comments, and now we still see S&P and Nasdaq both down 4% with a couple hours to go in the trading session, 4 hours to go in the trading session. He also then said, as Jen referenced in the Q&A, that we're not in a hurry.
Right.
I think that, look, we were chatting about it in the newsroom. You could make the argument. I know yesterday there were some folks saying, oh, now the Fed's going to cut 4 times this year. He left the door open to raising rates this year as much as he did to more aggressive rate cuts. Is the Fed going to raise rates this year? I would be very surprised. But the way that Powell outlined in his prepared remarks, specifically his assessment of what we've learned in the last 48 hours, is exactly where he's wanted to be, which is room on both sides to move. And I think the real emphasis on inflation is going to change maybe some of that thought around how the Fed, how their reaction function may come through in this moment. So we have inflation expectations, he's not in a hurry. And then there was another moment that maybe it doesn't mean anything, but he referred to, in other crises. So, is this a crisis now?
Right.
I think,
I was struck by that as
right?
well. Yeah.
We are now in a position where Powell's very good at saying very little, but he's also pretty honest, and he's also pretty relaxed, I think, in that kind of a setting. He clearly was, as you would expect, the most comfortable 3 on the stage, but he let that slip, or he just he's calling it like it is. The market's gone down 7% in a couple days.
Yeah.
To me, that feels like a crisis.
It does feel like
but
a
I'm not the
crisis.
Fed chair, so I can just say that. But he even acknowledging we could be in that situation, I think, is showing just how fragile this moment is.
Right, and he said also, he acknowledged the tough spot that the Fed is in when he said you have risks for high unemployment, you also have risks for higher inflation. And he said that's not a place that the central bank wants, that's not a position that we want to be in. It's an uncomfortable place for a central bank to be in. So that also sort of acknowledges the limits of what they're able to do if that indeed ends up being the case more than it is now.
Yeah, particularly since we came into this year with, I think, and he referenced in the Q&A that, we have to focus on whichever side of the mandate is more pressing at any one point in time, which I also took as implying, as his speech, I think, made clear. We came into this year, the labor market was the discussion. How much unemployment will the Fed tolerate? Now, this morning's numbers are I guess they don't have to worry about that, right? Unemployment is still 4.2%, but we've now had a Fed that I think left 24 with a view to we've mostly accomplished our inflation goals. We can begin easing. We've been in restrictive policy. Let's kind of let the cycle normalize in 25, and now they're ripping up the script and once again turning back to the inflation side of the mandate, which has given them plenty of challenges over the last few years.
Yeah, well, Miles, thanks very much for coming on to chat with me about it. As we leave you, I just want to point out what we've been seeing in the markets here. We've been seeing stocks fall to the lows of the session as we were hearing Jay Powell speak. The NASDAQ Composite and NASDAQ 100 have entered bear markets, down 20% from their highs. And as Miles pointed out, we're seeing steep selling over the 2-day period. That's it for Wealth. I'm Julie Hyman. Thanks for watching. Keep it here for an encore presentation of today's episode of Catalyst that's already in progress.